name is Mishek Samanyanga. So I'll quickly take you through the break-even model that I developed during the COVID period, whereby we're trying to find a point or in terms of volume of business that could allow us to cover up for our costs or to break even. So this model was built in a hospitality setup or a hotel environment. So most of the metrics you'll find here, they are hospitality based. So as you know, the formula for break-even point is fixed costs divided by contribution. And in this case, contribution is revenue per room minus variable cost per room. So meaning to say, for us to get the break-even, we need obviously those three fundamental components. So we need the fixed costs, then we need the revenue per room. Then we also need variable cost per room for us to find the contribution that covers up the fixed cost. So meaning to say, what we need then to do is to take all our costs and be able to split them into cost behaviors. So cost behavior generally can be fixed. It can be a variable or semi-variable. So what do we mean by fixed? As you know, fixed meaning to say it's constant. So there are costs that do not move based on volume of business. For example, rentals, salaries mostly. Those ones remain constant. Either the companies, either the hotel or the lodge is 100% or is 2% occupancy. The salaries generally will remain the same. The rentals will generally remain the same. So those are fixed. Then we have variable costs. These are the costs that increase in line with volume of business. So you'll find costs like, for example, the food cost. Obviously, the more the guests eat, the more the cost also that you incur. Even the printing and stationery, sometimes also the more volumes you have of business, the more printing material that you use. Also, those might follow, like even the guest supplies and so forth. All those ones, they follow also the volume of business. So that's why we need now to split this cost, each and every line of cost, into fixed and variable. So I'll quickly run through for the sake of time. So what I've done here, I've tried to set up three periods. This is the focus month is the month that we need to find. We would like to find the break-even point for. We called it the focus month in this case, and then the base month. The base month is a month of reference, but this month the condition is that it should have a lower occupant than the focus month. That is very important because the main purpose of the base month is used in calculating semi-variable cost. But for semi-variable cost, it will need a reference point to see if there was a change from the base to the focus month. And that change, that's how it can be able to calculate or to split the cost between fixed and variable. Then we come to the standard month. The standard month is a month that has got a normal cost, whereby the costs for that month are not out of line. Because there are some months that got crazy costs, whereby maybe there were some costs that were forgotten in the previous period and then they are dumped into one month, which they don't belong to. So we are trying to look at a month that has got normal or reasonable costs that fall into that month, which we can use to judge performance of a focus month versus what our standard is. So it borrows from the standard costing aspect, right? So here, that's where you can switch. For example, you want to see the break-even point, and the magic happens here, the calculations. So here you can choose any month that you want, and here the break-even point will calculate. So there are three metrics for break-even point here. We have break-even point in rooms terms, we have break-even point in our occupancy, our percentage terms, and then we have break-even point in revenue terms. So this is how many rooms do we need to sell for us to break even. Then this is what occupancy do we need for us to break even, and how much revenue do we need to generate for us to break even. And these are the standard for the standard month, what is expected. And here, look at this red notification that pops up here. This one is trying to alert you that your base month has got lower occupancy, which means it is violated the rule. The rule is that the best month should have a lower occupancy. So, meaning to say you have to find another month to use as a basis. So in this case, we are going to change the focus month to August. Yeah, then the message goes off. So it means even if you look here, the occupancy increased. Base month is 58%, and then focus month is 69%. This is the logic that you want. Yes. And then here we also do a revenue mix calculation. Like in a normal month, like what should be the proportion of your revenues? Rooms, what component should it have? F&B, conferencing, and the other. So in this case, the standard we say if we have in a standard month, normally the rooms should contribute 42%, the F&B around 23%, conferencing 36%. So this is what we call the standard or the normal. And now in August, what exactly happened? For example, if August was an actual month, so August had rooms at 31%. So you see rooms was lower than the standard. Then food contributed a lot. That's 28%. And conferencing also contributed even more, 41% versus 36% standard. So these are important metrics as well. So now let's come to the split of the cost between variable and fixed. So here you have to define the cost behavior. This is very important. So if you define a cost as a fixed, it will definitely go under fixed. So this is the formula for doing that, splitting that. And if you define a cost discretely as variable, it will go under variable. So a bit of challenge comes when a cost is semi-variable. So it is partly fixed and partly variable. So let's go to such kind of cost. Yeah, it's here. Yeah. So this same variable, it means our cost increased from 34 to 43. Then the split happens here, like this. So normally, if it is a semi-variable cost, so the increase in occupancy is more than the percentage increase in cost. For example, here the occupancy increased by what? 69, 58. So this is what? This is 18%. And 18%, the same variable here, it increased by what? By 243 from 34 here. So this is 27%. So what does this mean? So meaning to say, if the increase in the variability of the expense was more than the increase in occupancy, this is more aligned to be a variable cost. So even the split that happens here, if you can see, we have a bigger chunk of the variable component here, which is 39, and then a smaller portion which is fixed. So that's how it splits. And then if you go here also, I can take this one. How did it increase? It increased by 19%, almost in line with the occupancy. And you can see also the split here that happened. So 128 was allocated to fixed component, and then 272 to variable component of the expense. So this quickly does the calculation just by you selecting the map here. It splits automatically the cost between variable and fixed cost. So these are the costs that we need for our calculations now for the break-even. However, take note, each and every cost is got a cost driver depending on the maybe department. So there's this section up here whereby we have cost drivers here. For example, if it is rooms, they are driven mostly by room nights. If it's something like to do with in-house, yes, then it has to have bed nights. If it is a conferencing, a banqueting and conferencing, normally the conferencing covers are the ones that are drivers of the cost. Yeah. and then you can define them. F&B is obviously F&B covers, they drive the cost. So you define these ones, and then here you state what department it is. Here, this is POMEC, this is maintenance. So all these are defined here, and then they'll pick the cost driver, and these are the cost drivers here. So these are cost drivers for the base factor, that is the base month, and this one for the forecast, the month that we are looking at, and this is the cost driver for the standard month. So once these costs are split, just by a split of a second, then here that's where we are mostly interested in at the end of the day. So you can see that in this month, which August was our forecast month, our break-even point for this month in revenue terms, we're supposed to make at least 663. These are in US dollars. 633,416. So for us to break even, and in occupancy percentage terms, we're supposed to make at least 18% occupancy for us to break even. And in terms of number of rooms, we're supposed to sell at least 1,716 rooms for us to break even. So this is how the model works. And it perfectly calculates all these metrics automatically. So what you just need to do is to link your P&L or your income statement and your forecast maybe into this model. You feed into this model so that when you update your P&L or income statement, it will come and feed here. When you update your forecast, also it will come and feed here if maybe it is not yet the end of the year, so that then you can be able to select any month that you want to check what will be the occupancy. This is a very good model also for use by the revenue team. I think when they are simulating to find how business is going to be, at what point, if our occupancy is this, what will be our profitability. So it works very well also in that respect. So this model it has been tried and tested in a number of hotels, in a number of and in lodges as well. It works perfectly well. You can fine tune it. Also, you define your parameters, the cost drivers. Yeah, like I said, you define also your cost behaviors, and then it will do the magic. It will calculate the fixed cost and sum the fixed cost here, and also the variable cost. So variable cost per room, obviously it is the total variable cost and the number of rooms sold. And then the fixed cost, which is the numerator, this is 418. If you see maybe the calculation here of break even, like here, yeah, you see, yeah, and its base obviously is the number of rooms sold to get revenue per room, right? Then the break-even point in terms of total rooms, they're like we are multiplying. We are saying the T6, which is fixed cost, the formula of break-even, divided by the contribution. What is the contribution? Contribution is revenue per room minus variable cost per room. That is the contribution. So if you put this as the denominator and then the numerator being the fixed cost, then you get your number of rooms, which are break-even rooms. That's how we get it. Then the occupancy obviously will be break-even rooms here, divided by available rooms for the month. You get your break-even occupancy. Then for the total revenue, this one, you simply multiply your break-even rooms times the revenue per room. So you get your break-even revenue. So this is in brief is the break-even model. You can try it out maybe to I'll touch base in the next episode on this standard cost aspect. It's very important. This is important, especially for variance analysis, how we have departed from the standard month. And you can see where we made some savings here in this color. It's almost green. And then where you see positive, it means you went above the standard, what you were expected to achieve based on the standard. And the overall, you have at the end of the day here the net effect Here, if you sum together the variances, you get the net, either you are above or you are below. Yeah, like this, you can see 345 above. So this is the break-even model. Is you define, you develop it once, and it will work consistently throughout. Unless you change the format, you can also customize it to fit your income statement format. It's brilliant. It tells you a lot of story. It simplifies break-even model beyond measure. Thank you so much for your time and for listening.